Hi everyone, welcome back. This section is going to specifically focus solely on indicators and indicator usage. Here's an overview of the section. So this will serve as an introduction to indicators, including what they are, how they work, how to use them, and various strategies associated with each of the different indicators that we're going to talk about. They're all used in different ways. We'll also talk about different types of indicators and break them down, including moving averages, Bollinger Bands, the MACD, RSI, and many more. And overall, we'll talk about the benefits and drawbacks of indicators and how to best utilize them to support your crypto trading. So let's first talk about indicators. So indicators are tools that can help traders analyze markets and charts. Indicators are based on calculations taken from data based on price action, volume, and other statistics based on a market or a certain financial asset. And many indicators will display this information in the form of patterns, shapes, colors, and different lines to help the analyst visualize data. It's just another way to visualize data other than candlestick charts. Now, they can be useful when attempting to identify trends and patterns in an asset's price or volume status. Now, indicators are very popular and especially with beginners. Beginners love indicators. They find that they flock to them because they might find that they're easier to understand. It is important to know that indicators are always derived from price itself, meaning that the data that the indicator shows and the data that the indicator is sourcing from always comes from the chart itself. So sometimes it's always better to focus on the main part of the chart, meaning price candles, volume, price patterns, trends, levels of support and resistance, market structure, all those things that we have discussed in the other sections of our trading class, and focus on that and use that as the main part of your trade idea, and then let indicators support your trade idea. It's really important to not trade off an indicator by itself. Just because an indicator has a certain setup and you don't really see anything else going on in the chart to help support that idea does not mean you should take that trade, whether that's a long or a short. So this is just a forewarning and something to keep in mind as we're going through indicators. Indicators are a useful tool, but they are not everything. Now, the first indicator we're going to discuss is the moving average. It is taken in the form of a line shown underneath candlestick charts as shown above. So one of the most popular and basic technical analysis indicators is the moving average. It's commonly shortened down to just MA. Now, moving averages are made up of averages of different data groupings taken from a full set of prices. What does that mean? An example, let's say we're just looking for the average price over the last 10 days, or maybe the average price over the last 50 days, or maybe the average price over the last 100 days. So instead of focusing on specific candle closes and where the price is going, we're looking at an average of a group of candles. Now, it's used to help remove unnecessary market data, which is often called noise, by displaying price averages over a period of time. And the main benefit of this is that random and minuscule or meaningless price changes and fluctuations are ignored in favor for averages. We get to see the real meat of the market. Where is the market going? What kind of direction is the market going, without all the fluctuations and volatility that we often see, especially in crypto. So here's an example of various moving averages on the right. So moving averages smooth out the information shown in the charts by focusing on the average price of an asset rather than focusing on the actual price and the many fluctuations that occur. So here we see on the right side, this is a rather volatile chart, right? It's starting from this low point in the bottom left corner. It comes up, it comes back down, up, down, and it's, it's green, it's red, it's green, it's red. There's a lot going on. The moving averages, as we see with these lines, these color-coded lines, they help smooth out this price data. And here we see 3 different moving averages. In the black, we see the 50-day moving average. So this means that this is taking the average closing price. Typically, it's closing price. That's something that you can set, but for the most part, it's the closing price, the average closing price of the last 50 days or the last 50 candles in this particular case. We're assuming that this is a daily chart. And as we see, as price is going up, the moving average isn't necessarily going up at the same time because it's factoring in all of the data that came before it. Only after price is starting to settle and remain at a certain higher level, then the average finally balance out and factor in the more recent price data, because as time goes on, old data is removed from that average and the newer data is added in. We see the same in the red. This is the 100-day moving average. So this is taking in a bigger sample size, right? It's taking in 100 days worth of closing price data and then making an average based on that. And then the 200-day is in an even larger average or even larger sample set where it's taking 200 days worth of average price data and then formulating an average based on that. Here's an example of Solana. So this is Solana on the daily chart, where each one of these candles represents 1 day's worth of price action. As we see here in the top left, you'll see this is the moving average. This is the 50 moving average. So this is based on the previous 50 days worth of price data, particularly the close. Once again, you can alter these settings so that it could be based on open or based on close. Typically, most people keep it on close. I wouldn't worry about that too much if you're a beginner. And as you see, this is factoring in this price data for the 50 candles before it. So let's say we're starting over here. The moving average is currently around, so the closing price was about, let's say, $135 in late September in this time period. At the same time, the 50 MA or the 50 moving average was about 120 because it's factoring in all of this data, the previous 50 candles before this, right? So it's factoring all this data. The average price is probably around here, give or take, because we have these lower prices here and we have these higher prices here. We're taking an average of this whole sample size, and then it is plotted on a line chart. So moving averages can be based on a variety of ranges, such as the 10 period, the 50 period, 100 period, or larger. MAs of 10, 20, 50, 100, and 200 period ranges are commonly used. There's many different combinations, and it really depends on your trading style. I know the 50 and the 200 period are commonly used, and I personally use those as well. We'll take a look at some of my own analysis using them. I find them to have a nice balance between a more near-term or shorter-term average found in the 50, and then the 200 period showing a more longer-term trend or a longer-term moving average on the given asset. Now, long-term investors may prefer to view larger data sets such as the 200-day moving average because it's less likely to be affected by price fluctuations. If you think about it, we're taking a larger sample size. So, random spikes to the upside or random dips or flash crashes to the bottom, to the downside, are less likely to affect this because it's such a larger sample size. If it's red or lower for 5 days out of the 200 days, that's not really going to make a particularly large difference on the overall average of that data. Now, short-term investors or traders may prefer to look at smaller data sizes, such as the 50 period or shorter, as it's based on more recent market data and can benefit reactionary investments or trading in this particular case, right? Typically with trading, we're reacting to the market based on more short-term effects or short-term fluctuations, right? Volatility compared to a long-term investor. I wouldn't stop yourself from using the 200-day moving average because you consider yourself a scalper. I find that these tools are useful regardless of your style of trading, or if you're an investor or if you're a trader. Well, if you're an investor, you probably aren't looking at indicators too much. You're probably just holding for the long term, right? Now, if you're looking to profit off of volatility, which is what traders mainly do, it's useful to keep in mind of all the data sets and try to find a system that works best for you. I personally like the 50 and the 200 period and using a combination of that, but there's a lot of different combinations, and we'll talk about those in a little bit. Now here's an example. We're going to go through a couple examples of different moving averages and how they differ looking at the same chart. So here is the Ethereum US dollars. This is a daily chart, and we're mainly focused on the time period between February 2021 to about November 2021. So we saw a really dramatic rise in Ethereum, breaking past previous all-time highs, producing this extreme all-time high in May, falling down to range to market lows in over the summer in June and July, and then retracing back to the upside and producing more all-time highs, particularly in late October, early November. Now, the moving average we have displayed here is the 9-period moving average. So this moving average is factoring in the previous 9 candles worth of data, the closing prices, and taking in those 9 closing prices, adding them up, dividing by 9, that's your average. And then we're plotting them on our line chart. So as we can see here, because it's such a smaller sample size, it's going to be fairly close and fairly similar to the actual price movement and fluctuation of the asset itself. So Ethereum, as we see, is following this pattern. It comes up here, and the 9 period is really not too far off. It's really staying fairly true and fairly close to the overall market structure and in the given trend at the time. Now, to contrast that, here is the 50 period. Here we see it's not as close to the overall market structure or the overall market patterns that are being displayed. So here's the 9 one more time. As we see, particularly here throughout May, it shoots right up and really follows the overall price movement as it breaks past to a high of 4,400. Here on the moving average 50, because it's factoring in the previous 50 candle closes worth of data, it's not going to react to a sudden spike as we saw here as much as the 9 period, right? We do see an increase, but not as dramatic, and it's much more prolonged and slower to react to these market fluctuations, whether that's the market breaking out to the upside or retracing back down, right? The market's coming down here at this point, but the 50 moving average is still somewhat moving up, right? Obviously, the gradient of, or the rate of change, rate of increase on the moving average at this point from May, June into July it's not as dramatic as it was in April and May. It's not as high of a slope, if you will, but it's still increasing, whereas here we're seeing a dramatic decrease. Now, even here, we even see more of a dramatic rate of change difference. This is the 100 period moving average, so this is taking even a larger sample size, and here we're seeing that it's taking even more time to play out. Here we see overall prices coming down, particularly in May into June and into July. The 100 period moving average is still moving upwards for the most part. I will only really about here, give or take, is when we start to see a decline in the moving average. This would be in late July, and even then we're starting to see a reversal to the upside. So we're seeing the actual price of the asset itself of Ethereum is going up, particularly from late July going into mid August, give or take. At the same time, the 100 period moving average is staying relatively flat compared to, let's say, here's the 9 period, which is very quick to react to price fluctuations because it's based on a smaller sample size. And finally, here's the 200 period moving average, just a general slower slope. What's interesting here is that we do see price coming down, wicking down near to this area, price coming down to this area acting as a level of support, you could even say, or even here acting as a level of resistance when price broke below. So it is useful to keep in mind and look at these larger moving averages. I particularly like the 50 and the 200. This is the 200 we're looking at right now. I have found it to be not necessarily reliable, but a level of importance, whether that's as a level of resistance when price is below it, or as a level of extreme support if a price is above it.